Assalamu'alaikum warahmatullahi wabarakatuh. Hello everyone. Introduce us from group 2. We will discuss about current liabilities and non-current liabilities. On this occasion, group 2 consists of 4 people. The first I am Ameliya Widiyawati, and then Anisa Nur'aini, Indriyani, Fatika, Sari, and Risangayu, Puji, Prasetya. Okay, we will start from current liabilities, provisions, and contingencies. Okay, provisions. Provision is a liability of uncertain timing or amount reported either as current or non-current liability. How does the company determine the amount of provision reporting? According to IFRS, the amount recognized should be the best estimate of the expenditure required to settle the present obligation. The best estimate represents the amounts that the company would pay to settle the application at the statement of finance position date. And then terms of recognition, the company records expense and liabilities related to supply only if the following 2 conditions are met. 1, warranty. 2, probable certainly case of outflow of resources involving obligation. 3, can be estimated reliably. And then common type of provision. Number 1 is litigation provisions. Number 2, warranties. Number 3, premiums. Number 4, environmental. Number 5, onerous contract. And number 6, restructuring. Okay, litigation provisions. Companies must consider the following in determining whether to record a liability with respect to pending or threatened litigation and actual or possible claims and assessment. Number 1, time period is which the underlying cause of action occurred. Number 2, probability of an unfavorable outcome. 3, ability to make a reasonable estimate of the amount of loss. And then, for example, Scotches is involved in a lawsuit at December 31, 2010. A, prepare the December 31 entry assuming it is probable that Scotches will be liable for $900,000 as a result of the suits. B, prepare the December 31 entry if any, assuming it is not probable that Scotches will be liable for any payment as a result of the suits. And the answer, lawsuit loss in debit amount of $900,000, and then lawsuit liability in credit 900,000. And B, no entry is necessary. The loss is not occurred because it is not probable that a liability has been incurred at 31 December 2010. And then warranties. Warranty provisions. Promise made by a seller to buyer to make a good on a deficiency of quantity, quality, or performance in a product. If it is probable that customers will make warranty claims and a company can reasonably estimate the cost involved, the company must be record an expense. Warranty have 2 basic methods of accounting. A, case basic method. Expense warranty costs incurred because it is not probable that a liability has been incurred, or it cannot reasonably estimate the amount of the liability. And then number 2, accrual basis method. Charge warranty costs to operating expense in the year of sale. And 2 method is the generally accepted method, and then referred to as the expense warranty approach. For example, Strip Factory provides a 2 years warranty with one of its products, which was first sold in 2010. In the year, Strip spent $70,000 servicing warranty claims. At year end, Strip estimates that an additional $400,000 will be spent in the future to service warranty claims related to 2010 sales. Prepare SEP's journal entry to record the $70,000 expenditure and the December 31 adjusting entry. The journal is 2010 warranty expense in debit, amount of 70,000, and then cash in credit, 70,000. And then warranty expense, amount of 400,000, and warranty liability, 400,000. And then premiums and coupons. Companies should charge the cost of premiums and coupons to expense in the period of the sale that benefits from the plan. According to accounting, estimate the number of outstanding premiums offers that consumer will present for redemption. Change cost of premium offers to premium expense and credit premium liability. For example, illustration, Fluffy Cake Mix Company offered its customer a large non-breakable mixing bowl in exchange for 25 cents and 10 box tops. The mixing bowl cost Fluffy Cake Mix Company 75 cents, and the company estimates that customer will redeem 60% of the box tops. The premium offer began in June 2011 and resulted in the transaction journalized below. Fluffy Cake Mix Company record purchase of 20,000 mixing bowls as follows. The journal is inventory of premium mixing bowls, amount of 15,000 and debit, and cash in credit 15,000. The number is obtained from 20,000 times 0.75 is 1,500. And then illustration, the entry to record sales of 300,000 box of cake mix will be cash in debit 240,000, and then sales in credit 40,000. This number is obtained from 300,000 times 0.8. And Fluffy records the actual redemption of 60,000 box tops and the receipt of 25 cents per 10 box tops, and the delivery of the mixing bowls as follows. Cash 60,000 divided by 10, and then times 0.25 $25 is 1,500, and then premium expense amount of 3,000, and then inventory of premium mixing bowls is 4,500. This is a computation, and then 60 divided by 10, and then times 0.75 is 4,500. And then finally, Fluffy makes an end of period adjusting entry for estimates liability for outstanding premium offers or box tops as follow. Premium expense 6,000 and premium liability 6,000. And then the computation can you see on the screen. Okay, for the next material will be explained by Indriyani, Fatika, Sari.
Okay, next, environmental provisions. A company must recognize an environmental liability when it has an existing legal obligation associated with the retirement of long-lived asset and when it can reasonably estimate the amount of the liability. Obligation event. Example of existing legal obligation which require recognition of a liability include but are not limited to: first, decommissioning nuclear facilities, dismantling, restoring, and reclamation of oil and gas properties, certain closure, reclamation, and removal cost of mining facilities, and fourth, closure and post-closure cost of landfills. Measurement. A company initially measures an environmental liability at the best estimate of its future costs, recognition, and allocation. To record an environmental liability, a company includes first the cost associated with the environmental liability in the carrying amount of the related long-lived asset, and two, records a liability for the same amount. Okay, for the example illustration, on January 1, 2010, Wilcap Oil Company erect an oil platform in the Gulf of Mexico. Wilcap is legally required to dismantle and remove the platform at the end of its useful life, estimated to be 5 years. Wilcap estimates that dismantling and removal will cost based on a 10% discount rate. The fair value of the environmental liability is estimated to be 16 and 2920. Wilcap records this liability on January 1, 2011 as follows. In debit, drilling platform, and in credit environmental liability. Next. Illustration during the life of the asset will allocates the asset determine cost to expand. Using the straight line method, Wilcott makes the following entries to record this expense. December 31, 2011, 2012, 2013, 2014, and 2015. In debit, depreciation expense, and in credit, accumulated depreciation. Next illustration. In addition, Wilcott must accrue interest expense each period. Wilcott records interest expense and the related increase in the environmental liability on December 31, 2011 as follows. December 31, 2011. In debit, interest expense, and in credit, environment liability. Next. Illustration on January 10, 2016, Wilcott contract with reclaimers in to dismantle the platform at a contract price of 19,095. Wilcott makes the following journal entry to record statement of the liability January 10, 2016. In debit, environmental liability, and in credit, gain on settlement of liability and cash. Next, the unavoidable cost of meeting the obligation exceeds the economic benefits expected to be received. The expected cost should reflect the least net cost of shifting from the contract, which is the lower of, first, the cost of fulfilling the contract, or the compensation or penalties arising from failure to fulfill the contract. For example, Sumbar Sports operates profitably in a factory that it has leased and on which it pays monthly rental. Sumar decided to relocate its operation to another facility. However, the, the lease on the hot facility continues for the next 3 years. Unfortunately, Sumar cannot cancel the lease, nor will it be able to sublet the factory to another party. The expected cost to satisfy this onerous contract are 2,100. In this case, Sumar makes the following entry: loss on lease contract in the debit and lease contract liability in the credit. Assume the same facts as above for the smart example, and the expected cost to fulfill the contract are 2,100. 2,100. However, Sumar can cancel the lease by paying a penalty of 175. In this case, Sumar shall record the liability as follows: in debit, loss on lease contract, and lease contract liability in the credit. Next, restructuring. Restructuring are defined as a program that is planned and controlled by management and materially changes either first the scope of business undertaken by the company, or second the manner in which that business is conducted. IFRS profit specific guidance related to certain costs and leases that should be excluded from the restructuring provision. Next, contingencies. Obligation contingency are not recognized in financial statement because they are first a possible obligation not yet confirmed. Second, a present obligation which is not probable that payment will be made. Or third, a present obligation for which a reliable estimate of the obligation cannot be met. A contingent asset is a possible asset that arises from past events and whose existence will be confirmed by the occurrence or non-occurrence of uncertain future events not value within the control of the company. Typically, contingent assets are first possible receipt of monies from gift, donation, bonus. Second, possible refunds from the government in tax disputes. Third, pending court cases with a probable favorable outcome. Contingent assets are not recognized on the statement of financial position. Contingent assets are disclosed when an inflow of economic benefit is considered more likely than not to occur greater than 50%. Presentation obligation fund usually report at their full maturity value. Difference between present value and the maturity value is considered immaterial. Okay, current liabilities analysis. Liquidity regarding a liability is the expected time to elapse before its payment. Duration to help assess liquidity are first current ratio. Ratio in current ratio, current asset divided by current liabilities. So, the equation current ratio is activa divided by current liabilities. The equation activa not receivable divided by current liabilities. Next, contingency presentation. Company take notes class contingency and obligation if the loss is an estimation which could confirm and if possibility less small. So disclosure must be load, nature, contingency, and estimation possibility less a number of obligation contingency others who must disclose the possibility loss which will fetch company small as guarantee on debt party other and guarantee for by return account receivable. Okay. Uh, in the screen, in the screen presentation of current liabilities. Current asset and Nokia Corporation, December 31. In the screen, uh, current asset and current liabilities. In the current asset, inventories, account receivable, net of allowance for debt accounts, prepaid expense, and accrued income, current portion of long-term loans receivable, other financial asset, investment liquid asset, investment cash equivalents, bank and cash. And in the current liabilities, current portion of long-term loans, short-term borrowings, other financial liabilities, account payable, accrued expense provision.
Okay, the next material we have non-current liabilities. Non-current liabilities or long-term debt is an obligation that are payable more than 1 year or one period, usually needed for meet the funding needs for business expansion. The advantage of long-term debt is first, bondholders don't have voting rights, so that no take effect on management. The second, bond interest can be lower than dividend which must pay to shareholders. And the third, interest can be charged to expense so can reduce tax while dividend are not. Next. The provision agreement of long-term debt is the first recipient loan must maintain level minimum capital. The second, loan recipients are prohibited from selling receivable in order to generate cash. The third, recipients of long-term debt agreement usually are required to guarantee their fixed assets to the lender in the form of a mortgage. And the last, limiting further loans by prohibiting additional loans or requiring the additional debt to be subordinated to long-term debt. Next, the characteristic of long-term debt is usually due between 5 to 20 years. These debts have criteria: the first, data storage and reporting; the second, payment of taxes and maintain a business that is included as part of a company that applies for debt of or loans.
Next is the general requirements for drafting a long-term loan agreement usually include the following. First, borrowers are required to keep accounting records in accordance with general principle accountancy, which are acceptable. Second, submit the company's financial statements that were previously audited periodically. The next is borrowers are required to pay tax as well as other obligations do. Next is borrower must be able to maintain all facilities owned by the company in good condition so that they are always in a running state. The next is debt agreement recipient period usually also have to place fixed assets to the lender in the form of a mortgage. And the last is limiting the number of subsequent loans by prohibiting additional loans or requiring the additional loans in question to be subordinated to the previous loan. Next is long-term debt from side investors and creditors. In terms of risk, debt period long, like because capable give priority good in terms of income or liquidation of the holder. The second is from side income, give a loan will get returned by permanent except bond. And the last is from side control usually company no have right voice. And before we talk about risk long-term debt, I will tell you that the main factors are influence the interest rate on loans, namely the benchmark cost of money, maturity time, loan risk, and the size of the loan. Long-term loans can be seen from various sides, namely as follows. Uh, Long-term loan holders, there is an investor and creditors, and issuance of long-term debt, it is issuer and debitor. And then risk long-term debt. Having long-term debt is not only profitable and can provide benefits to the company, but also has some risks. Some risks of long-term debt include one is the longer the loan period and repayment period, the higher the risk. Next is can only obtain limited source of funds from loan proceeds. The third is debt is a fixed burden that must be borne by the company. The fourth is have a definite or fixed deadline for payment of debt. And the last is it is likely that the value of the company's shares will decrease due to high or low levels of borrowing. Next, uh, the type of long-term debt is first debt mortgage, two notes payable, and three bond payable. Next. The debt mortgage and notes payable will be explained by Miss Nisa.
Okay, the first we have debt mortgage. Debt mortgage is a debt arising from the income of funds originating from debt with the use of fixed assets as collateral, treasure, permanent which match guarantee is treasure with no more as land and building. If company not able to pay off, so giver debt has the right to confiscate or sell fixed assets that the collateral. Next. This is the example case of debt mortgage. On January, on the 1st January 2017, PT Arsenio received a mortgage loan from Bank Medion amounting to 16,000 with 12% interest paid every 1st of March and 1st of September with a house and land guarantee of $100,000. The mortgage is paid in installment every the 1st of August. and start to the 1st of July 2018 will the amount of each installment of $20,000. Prepare all Prepare all journal entries, including recording, adjusting, closing, and turning journal for 2017 and 2004 and 2018. Next, this is the solution about that case. The journal record is cash on debit and mortgage payable on credit for $60,000. Next, this is a calculation of interest payment at the 1st of March 2017 is 2 per 12 times 12% times 60,000 equal to 1,200. The journal of this transaction is interest expense on debit and cash on credit for 1,200. In the 1st of September 2017, the interest expense is 3,600 with journal entries, interest expense on debit and cash on credit for 3,600. Then, this is the journal adjustment, closing, and turning journal. The adjustment journal is interest expense on debit and interest payable on credit for 2,400. The closing journal includes income summary on debit and interest expense on credit for 7,200. The turning journal includes interest payable on debit and interest expense on credit for 2,004. The next is Journal of Interest Payment. Next. This is the Journal of Interest Payment and Installment in 2018. Journal of Interest Payment includes interest expense in debit and cash in credit for 3,600. The Journal of Installment Payment in mortgage installment are payable on debit and cash on credit for 20,000. And the Journal of Interest Payment of 1st of September 2016 is interest expense on debit and cash on credit for $3,400. Next. This is the Journal of Adjustment and Closing. The adjustment journal included interest expense in debit and interest payable in credit for $1,600. Mortgage debt in debit and mortgage installment are payable on credit for $20,000. And the closing journal includes income summary on debit and interest expense on credit for $8,600. The second type of long-term debt is not payable. Not payable are written documents that state the company's debt. For the party who will receive the payment, the promissory note is a receivable or bill called a note receivable. For those who have to pay, a note is a debt or obligation called a note payable. Next. This is the example of a note payable issued at nominal value. On the 1st January 2015, PT ABC issued a note payable with a nominal value of $1,000 with 10% interest and 5-year maturity period. Net interest is paid at the end of each year. The journal record of each issuance of note is cash on debit and notes payable on credit for $1,000. $100,000.
The next is bonds payable.
Will be explained.
The next is bonds payable. Bonds are letters of proof of debt issued by the company to the holder with a certain amount of interest. Each bond contains the nominal value of the bond and the interest rate on the bond. Bonds represent an agreement of payment of the amount of money to be paid at maturity and interest periodically to the same degree. The next is there is a 5-type bond. The first, bond guarantee, secure bonds, and without guarantee, unsecured bonds. It is an example of bond guarantee that is a bond mortgage which publishing guaranteed with something guarantee certain, whereas bond no guarantee is bond which publishing no dares is guaranteed so that very risky. Second is bond futures, glow, and cold redeem. Bond future is fall tempo in one date. Bond serials is fall tempo by serial or gradually. And bond cold redeem is a bond which give right to publisher for redeem and interesting before fall tempo. The next is bond convertible. It is a bond which gold converted becomes from security others, usually converted to share. And the fourth, bond registered and bond on show. It is a bond registered registered bonds that bond which include name owner and bond on show. It is bearers or coupon bonds. It is a bond which no include name owner. The last is bond profit and income. Income bonds is bond which paid without interest unless the company makes a profit. Revenue bonds is bond which the flowers paid from such income certain. Next, bond generally rated on score time. Now, from estimation rotation case time from which consists from flower and money, the main thing is the level of flower which said declared in percentage and often called with par value, principal amount, or maturity values. Liability issued at par value means the number determined by the buyer is the same as the figure specified. Example, the 3-year bond was issued with a par value of $100,000 on 1st January 2007, bearing an interest rate of 8% and a market rate of 8%. On the 1st January 2007, there is a carrying amount with $100,000. On the last December on 2007, in case $800 and interest expense $800. On the next last December on 2008 and the 2009, their same is with case $8,000 and interest expense $8,000. There is a journal is on the 1st January 2007, the case in debit 100,000 and bonds payable 100,000. On the last December on 2007, the journal is interest expense on debit $8,000 and cash $8,000. Obligation issued at a discount or premium occurs if there is a difference between the number determined by the buyer is different from that which has been set. The current value of the bond calculated by the buyer will be different from the face value of the bond. Discount is bond sold for less than face value, and premium is bond sold for more than face value. For example, a 3-year bond was issued at a par value of $100,000 on 1st January 2007 with a carrying an interest rate of 8%. Calculated bond issue price assuming a market interest rate of 10%. There is principal with 100,000 multiplying with 0.75 and 132. There is total is 75,000 with $132. And the interest is the total of interest is 19,000 and 800 with $95. So present value is 95,000 and $27 with a face value $100,000, and the discount is face value minus present value. It is the total. The total is 4,900 with $73. The journal on 1st January 2007 is cash on debit 95,000 and $27, and the discount on bonds payable is 4,973. On credit is bonds payable, there is 1,100. On the last December 2007, there is in debit is interest expense with amount $9,053. On debit, there are discount on payable with amount of $1,503, and then cash with $8,000. Obligation which published in among that flower, when bond published on that other than that payment flower, so buyer bond will pay flower bond which own from that payment flower final until that publishing. There is the last on our presentation. I will bring it back to Miss Ameliya.
Okay, thank you. Thank you for your attention and watching. Wassalamualaikum warahmatullahi wabarakatuh.